On 24th of January, a report released by US-based Hindenburg Research made some shocking claims about the Adani Group. The report alleged that the conglomerate used a web of companies in tax havens to inflate revenue and stock prices. Adani Group denied these allegations. What followed not just nearly halved Gautam Adani's net worth, but also triggered a reality check for banks, non-banking financial companies, and regulators like SEBI to understand the risks on account of exposures to Adani's energy-to-ports empire. According to a report by institutional brokerage firm CLSA, the debt to top Adani Group companies doubled to 2 trillion rupees over the past 3 to 4 years. Within this, bank funding was less than 40%, while bonds, financial institutions, and foreign banks formed a larger part of the group debt. To put that in perspective, the gross NPA of listed public and private sector banks was 6 trillion rupees as of December 2022.
In my view, the exposure to Adani Group is not material for Indian banking sector. Moreover, if you see in terms of percentage, it is hardly 1% of the total loan book of the banking system. Even in terms of the net worth, it is not very material, right? And if you go slightly deeper, you will see the private banks have even lesser exposure, and moreover, they have exposure to those cash generating assets like ports and other stuff. And however, the PSE banks have slightly higher exposure relatively, right? So if you bifurcate that 1%, 0.3 for a private and 0.7% for the public. So it is not material in terms of the NPA. So if you assume that entire book will become the gross NPA for the banks, so it will add up say 1% of total the headline number. So that would not be even the worst case scenario will not be very material for the banks. But yes, from a sentiments perspective, the stocks have underperformed or have seen some kind of beating on this news or this when we started getting this talk in the media.
Public sector banks have said that their exposure to the Adani Group is 1%, and there is no cause for worry. Some experts believe it is not the quantum of debt, but the ability to pay that counts.
And do they have repaying capacity each year? That is the point to be seen. And are the cash flows stable? That's another point to be seen. Are there the future expectation whether the cash flow is positive or not? That's to be seen. So from all those counts, there is no challenge to Indian banking system or Indian bond market that there is likelihood of any default as on date. There is no risk to banking system, domestic, global, banking system, non-banking system. That is the market.
NBFC.
Even the market, because they have market borrowing by way of bond and debentures, even that is not an issue. And they have enough cash which is being generated each year. But untoward incidents, nobody can predict, and they can happen in any scenario. That's nobody can comment to that.
So, what are the risks to watch out for?
So, if there's a decline in the earning potential of these companies, and a decline means significant decline, or there's any other event which leads to any cascading, then those are the events to be watched. Because even the Hindenburg report has not commented on the repaying capacity of the group. They have not said that point. That's not a point covered in their report.
On the Supreme Court's direction, SEBI and the government have to develop a framework to protect the investors. That said, troubles for the Adani Group may not be over yet.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.